All right, go for it, buddy. We are live.
Okay. Hey, welcome everyone to another weekly recap with Travis, and I'm Peter. Travis is my mentor, Frantor. He's your trainer in the Success Academy. Just want to start out real quick by saying, hey, this is for educational purposes only. Anything we talk about, any investments or trades we mention are strictly for educational purposes. We're not giving you an investment advice. We're not telling you what to do. If you're interested in learning what we're doing, then go increase your education. Talk to a professional first. Don't just listen to a recording on YouTube and take action. You will probably get in trouble. Having said that, I'm going to show you how to make tons of money. No, I'm just kidding. I think we'll switch to you, right, Travis? We'll let Travis is going to go through the general market, right? Do you want to go first? Do you want me to go first? Doesn't matter.
Well, since you're on a roll, go ahead. Let me get it to you.
All right, mine's going to be really quick. I'm going to talk about my Macy's trade, where I'm at. I touched on this last week, and I'll talk to you about where it's at. I really want to touch real quick on AT&T. And I had a couple of questions from the members area as to why I was trading AT&T. It kind of didn't fit the profile of what Travis teaches in the Success Academy. And then I'm going to answer my question that only one person responded to on Facebook, which had to do with where the market's at today, even though Travis is going to cover it. But okay, so Macy's, we talked about this. I don't have this is one of my paper platforms, so I can't show you my whole position, but you guys can see my screen, right?
Yeah, Travis? I can. Yep.
Okay, so Macy's is basically what I was going to do was unwind the position, right? So I sold an in the money covered call to hopefully be assigned, and it's already out of the money because Macy's is dropping. So that's okay. I'll keep the 150 I got paid for it, and in a couple of weeks that thing will expire worthless most likely, and I'll just keep doing that. I'm just going to keep selling an in the money, unwind this horrible mistake I made, mistake in the way that we don't teach you guys in the Success Academy. And for those of you that aren't part of our academy or any of our programs, it's definitely not a way to do it because you never know what a stock is going to do. So I will unwind that position. That's going to be a costly mistake I've made. But the good news I guess the bright side of it is I'll finally be done with it, and I will be able to move on from there.
Can I say something?
Ahead. Yeah,
not
absolutely.
Not a mistake at all. It was a learning experience.
Well, yeah, that's true.
Learning experience, not a mistake. Learning experience.
Sorry.
The psychology is entirely different. You have if you think something is a mistake versus a learning experience, entirely different psychology. Think it's a mistake. I'm sorry. Let me ramble real quick. Think it's a mistake, and you'll beat yourself up emotionally. You'll feel down on yourself. Nothing good comes from that. When you think it's a learning experience, your brain focuses on what you can learn from it, what you can gain from it, and how you can be better. So, just a learning experience. That's all. We'll have plenty.
You're absolutely correct, and you always touch on this stuff. How you really need to get your mindset correct by using the right terminology, because your brain will do exactly what you tell yourself. So,
yeah, right. That's true.
So that was a very costly experience for me.
Or profitable one, depending on where you look at it, because like 10 years from now, that learning experience is going to help make you a ton of money.
Exactly. And I think I mentioned that in the members area. It'll be about a $1,300 mistake, but I take that over a $13,000 mistake any day of the week.
Yeah. There you go again, a $13,000 learning experience.
Learning experience. Sorry. $13,000 learning.
Habits are hard to break, huh?
They are.
Sorry, I totally threw you off track. All right, let's get back.
That's okay. I'm writing down learning experience. Okay, so let me touch real quick on AT&T. Some of the folks in our academy have asked me, hey, why AT&T? It doesn't kind of fit the mold. AT&T has been going down for the last 2 years. Actually, if you look at AT&T, and you can do this at any given time, you take a 20-year monthly chart of AT&T, and you'll see 20 years ago AT&T was at $18, and today it's just slightly higher than that. It's kind of ranged. It had a high of $59. AT&T is not a stock I ever got involved with to make money off of the stock price. As a matter of fact, I don't trade that way anyway. I don't use stock price to make money because it's, to me, you're your number one, your profit potential is based on one of three potential scenarios. If the stock goes up, you make money. If it goes sideways, you don't. And if it goes down, you lose. So why would you give yourself a 1 in 3 chance? So for AT&T, the main reason I invested in AT&T, because it's an investment, it's not an expense to me. I invested in it for the dividend. I wanted a dividend stock that's going to be able to produce a dividend for my wife and kids when I'm not around. Now, it does take some management. You can't just go in it, without any kind of management. I don't think any investment you can do that. I don't think there's I really don't think that there's a passive income that you never work on. I think it's like Travis always talks about passive income. It's not really passive where you never work on it. It's low maintenance income is a better way of looking at it. And that's what my AT&T is. So I'm not overly concerned with the price of AT&T because I do work a lot on the fundamentals. I do pay attention to what the company's doing. I did recently pay attention to what they did this year with their dividend price because that was going to tell me a lot about AT&T, and they are sticking right to what they've been sticking with for the last 31 years. They increased their dividend this year, and they are a very strong company with their cash flow to be able to pay out their dividend, and that was the most important thing. So that's why I'm invested in AT&T. So why do I sell covered calls? Because the stock is going down. It's the best time to sell covered calls, and it just increases my revenue. I sell my covered calls at my cost basis, so if I get called out, I don't lose money, but I know I'm going to lose that dividend. Something I don't necessarily want to lose out on, but it's not a Macy's trade. That's the best way to put it. So that's my AT&T. I've covered enough on my reasons for not buying protection, but I actually do have protection. I sold a Leap vertical spread, and I will maintain protection on that in the coming years. As long as I own AT&T, my Leap protection right now is 2 years. So 2 years from now, I'll buy protection on it, and I will generate income off of it to pay for that protection. So, and then the last thing I wanted to kind of move on to, that makes sense, Travis?
Yep.
Anything
Sure
I said there? Okay.
Well,
Last thing I want
to.
Okay. Last thing I wanted to. Oops, I'm on something else.
And if it didn't make sense, you all can ask in the members area or below, wherever this video is posted.
Yeah, absolutely. Okay, last thing I wanted to talk to, we can look at the market, and Travis and I were talking about this, and he's mentioned it before. It's like, who would have thought the market doesn't typically go up this much this quick, right?
No,
this is a rarity. But I posted a question in the Facebook page, and it wasn't meant to be a prediction. It wasn't meant to say I'm right, you're wrong, or anything like that, or I don't know if I'm right. But there's something that I was paying attention to that Travis taught me to pay attention to a long time ago, and we teach our members to pay attention to, and that's moving averages. So you can see on my screen, I have 3 different moving averages. These are the moving averages I use. Some programs teach other ones, but this is what we use, 730 and the 200-day moving average. And 3 days ago, right? Yep, 3 days ago, prices closed right around the 200-day moving average. Moving averages can work as both support and resistance, and that's why I posted that in the Facebook area. If you were trading in a bullish direction 3 or 4 days ago, well, right now you're seeing that your trades are probably not doing well. If you sold anything at the money, you're at a loss right now. Mm-hmm. Is that to say it's going to continue? No, I can't predict what the market's going to do. I can only look at the market and do what it's telling me. And if you look back at the 200-day moving average back in these areas here, when it went below it and started to come back. Now, the short terms were a little different than they are today, but you can see prices barely got over in this area here, fell back down. Prices barely got over in this area here and really fell back down. And what did it do just 2-3 days ago? Didn't even get above it. It was just something that I had trades set up. I had bullish credit spreads bullish credit spreads I was going to place to kind of show you guys that, and on a small trading account. But I waited because I was too close to that. I was setting these trades up right around here. If you can see where I'm pointing, it's right on that last down day before the 2 up days. And I was like, I don't have enough time for it to either break through or bounce off that resistance and then break through, right? So the way I'm doing it is I'm waiting for it to go above it. So that's what I kind of wanted to get you guys to pay attention to. Remember that moving averages work as both support and resistance, right? So that 200-day moving average has just proven that it's a resistance point to the market right now.
Yeah.
That's it. Went way too long. Sorry.
It was good. Good stuff. Good stuff.
Thanks.
All right. I'm
going to change presenters.
All right. And before I share my screen, just want to give a shout out to all the trolls today. I have a shirt for you all. You see my shirt? And I'm truly being a 10-minute trader. I always tell people I make trades at my kitchen table. Hey, you know what they say, trading. I'm at my pajamas on and everything, you guys. So I'm a hot mess this morning. But I told Peter, I was like, yeah, I don't feel like going to the office today just to record a video. So let me go ahead and show you my screen here. All right, so what I want to do is kind of touch on what Peter talked about, the 200-day moving average acting as support or resistance. So here's another way of saying it. The times that feel emotionally safe to get in are usually the wrong times to get in. That's the crazy part about investing. And I said this like 2 or 3 recaps back. I said the market went up 16%. There are a lot of people like, oh, I missed out. They want to get in now. And I was like, bad time to get in. I should have clarified what I meant by that. What I meant by that is, again, the times where it feels emotionally safe to get in is usually the bad times to get in. The best time to get in is where it feels emotionally unsafe, like during a market crash, like you're on the news, everybody's screaming about how much money they lose, we're going to a Great Depression. Those are the actually best times to get in. So you have to run towards the fire versus running away from the fire. Think like a fireman, like not fireman, what do they call them? That's a gender bias, firefighter, right? So they are trained to run towards fires where we're like the civilians are like, oh, let's get away from this. So that's how you have to think. And so when I saw that, I'm like, yeah, the markets went up 16, 17%. A lot of people feel like they missed out. All that money you missed, it starts playing on your emotions. You're like, let me get in now because you like, it's going to keep raging higher without me. And you jump in. And what usually happens, the market falls on you or goes the opposite direction you want it to go. That's even if it's on the downside, even if you are lucky enough to know how to make money when stocks fall, it's the exact same way. The market falls like our last recent correction, right? The market was falling 20%. You're like, man, it's going to a bear market. It's time to load up on puts. And you load up on puts, and what happened? The market turned around and went up 16%. So you always have to be in tune with your emotions, and that's what I've learned. I'm like, it feels emotionally safe to get in. That means it's not a good time for me. That's not any kind of strategy. It's just what I've seen, right? And then you feel like you have a black cloud over you. So that's the first thing I wanted to talk about. Now, my trades, I talked about in the last recap. I said I felt like the market was setting us up. It's about to fall in price. I had zero proof, zero. But I said what I'm looking for, I trade what I see, not what I think I'm going to see. So I said, I'm looking for a close below a moving average or like a red trade triangle. And so let me go ahead and pull up Market Cup here. We can see that yesterday we had a red a red daily trade triangle. Okay, that's some kind of confirmation I'm looking for that prices in the next few days will fall in price. Is it guaranteed? No, but we can look back at all the previous trade triangles, and for the most part, they have been more right than wrong. So that's the kind of confirmation I'm looking for. And when I got that confirmation, I placed a few trades per my trade plan. And so I'll show you those trades. Now, this leads to people are saying new strategies this year. Travis is teaching new strategies. I take ownership of that, not being a clear communicator. We didn't learn any new strategies. I'm using the same strategies we've used all these years. It's a new approach. So if you can, try to change the language from new approach versus new strategies, because you'll get caught up on strategies, and it's not about strategies. It never is about strategies. It's always about approach or psychology. So strategy is Warren Buffett buys stocks or 50-cent discounts, or he likes to buy stocks when there's a discount. That's the strategy. A strategy is, get out of consumer debt, save 6 to 12 months of emergency fund, live on less than you earn, and invest the rest. That's a strategy. if it was about strategies, and all of us would be rich with six-pack abs, right? It's never about the strategy. It's about other things, the psychology, the emotions, the commitment, things like that. So if we get caught up on strategies, you'll miss the point. It's just a new approach. And the new approach is balanced risk, right? So last year, because the market has been volatile, I'm going to pull up a chart again. I'm just going to talk you through it. You have to see it with your mind's eye. So the market has been, up and down, right? Very volatile. So our approach this year is balanced risk. We're going to place trades that may have a profit potential of 500. All right, let me just show you my trade right here. So I placed on February 4th, I placed a bullish credit spread here that had maybe 4 days left until expiration. My potential profit was $480. So don't think strategy, think approach. Balance risk. How can I balance the risk of loss with this strategy? I could be wrong. The market could fall. And it did, in fact, fall, right? The market's falling right now. So this trade would have lost money. So I said, if the market does fall, how can I balance the risk of loss so that when it falls, I have insurance? Because I want to insure all of my trades this year. So it's think balance risk or think insurance. How can I insure this trade? And so I didn't place my insurance trade right away. But part of my trade plan was, okay, when the market falls, when I get a red daily trade triangle, then I will balance that risk and I will place a bearish credit spread, right? Well, no, not in this account. This is another account. So this particular account, and this is why I want you thinking approach and not strategies. Because if you think strategies, you might think I can balance the risk of this with a bearish credit spread. Just literally get on the other side. But nope. Because I was thinking balance risk, how can I balance the risk of loss of this trade? Peter gave you the answer a few minutes ago where he was like, and people don't catch that. We don't sell covered calls like everyone else. So like we know the best time to sell covered calls are when stock's falling. So I was like, okay, I already own 400 shares in this particular account. So if the stock falls, I want to sell a covered call. I want to make money when the stock falls. So with this account, because it's not about strategies, it's about approach, that I want to balance the risk of this bullish credit spread with a covered call. And that's what I did. You can see here, I sold 4 covered calls in this account that brought in 940. This trade had a loss. I sold 480, had to buy back for 820. So it had roughly a $400 loss. I'm balancing the risk of that loss with another trade that will profit when the stock falls. This approach is not about strategy. So cover call, most likely I'll make money. I have about a few days left. Is already up, I think, $300 profit so far as of today because the market's going down again. Okay, so again, think approach, think balance risk, think insurance. So try to move away from the strategy language. They say I want to balance my risk of all my strategies. And now balancing risk, you can do it however you want. You can come up with any kind of combination. So that's just one combination. I balance the risk of a bullish credit spread with a covered call. Now let me move on here because I have been rambling on for a while here. I talked about my trades, new strategies. So that's it. That's all the notes I have. I didn't have anything else to share. Any last takeaways, Peter?
I did. So I wanted to touch on something with your balanced risk approach. The other thing that I think sometimes I know our members have sometimes gotten a little confused on is they look at it and say, well, if you break even on both, you're not making any money, right? Well, we always talk about this because people need the reminder. What's the first rule? It's not, people don't get wealthy by how much they make. They get wealthy by how much they do not lose.
Mm-hmm. Yeah,
that is, true. I mentioned a book on last week's. That was the how I learned. Yeah, what I learned from losing $1 million.
Yeah.
And the guy's conclusion to that was everything Travis has taught us, which was, he looked at all these different gurus, and you can do the same thing. If you look at a Ray Dalio to a William J. O'Neill to a Warren Buffett, they all have two totally different approaches to investing in the stock markets. Mm-hmm. Sir John Templeton, totally different approach to all of them. But they're all multi-billionaires. How is that possible when all their approaches are completely different? What Warren Buffett says to do, Ray Dalio does the exact opposite. What Ray Dalio says to do, Sir John Templeton did the exact opposite. They all did different things. But the number one thing they all did the same, they didn't lose money. They limited the amount of money they lost. So when you're looking at this approach, number one, first and foremost, it's not about how much you're not making. It's about how much you're not losing, first and foremost.
Yeah.
The second thing is you're not always going to be wrong when you place your trades. When we talk about this, we're more wrong, but because we manage our risk, the ones that are right make more money than the ones that we lose on.
Mm-hmm.
Right?
Yeah.
So same with this approach. When Travis is wrong, he actually comes around break even. As a matter of fact, when I was looking at your spreadsheet, you were actually making money. But it was because the market dropped so much.
Yeah.
It doesn't typically do, right? And then you made money again because the market went up so much, which it doesn't typically do. But the reality of that program too is when you are right, you make money. When you are wrong, you don't lose money. That's the way you got to look at it. But you're going to be right every now and again, so you will make money.
Yeah.
The difference being you're not trying to catch up to make money to catch up for the losses.
That's true.
That was the only thing I just wanted to kind of caveat to that, because we've gotten a couple questions about it. People can't get their brains wrapped around it because they're only looking at worst case scenario. The reality is worst case scenario doesn't always rear its ugly head.
No.
But when it does, it seems to wipe us out because we never factored it in. Now you've factored it in, so it won't always rear its ugly head, which inevitably you're just going to make money because you're not going to lose a ton and you're not going to have to make up for it. That's it. I'm done rambling.
It's hard to wrap your brain around it because we are geared to always want to make money. We want to make the millions. We want to see our accounts grow. I get that. So people think the approach to getting your account grow is to focus on growing it. And it's so counterintuitive. No, the way to get your account grow is to focus on not losing money, right? To focus on protecting the losses. Now, when I say not losing money, don't take that literally like, you should never lose money. No, losing money is normal. You should lose money, right? That's normal. You have to minimize the damage of the losses, lose less than everyone else. So Peter said it. People are like, well, you're going to break even. Yeah, that's what I want. You're like, huh? How did you want that? Because last year I had a trade where profit potential of 500, loss potential of 300. Okay, the market was volatile. I lost 300. This year, profit potential of 500, potential loss of break even. Which one you think I like best? I like the break even. So I have it set up. I'm trying to set it up in theory that when I am wrong or the market does the opposite of what I want it to do, I break even. So the profit potential is still there, but I've minimized I put a cap on how much I want to lose. It's lower now. So just doing that systematically, I'm not going to win all the time. No, but if I keep consistent with that approach, making money becomes easy. It's almost impossible not to grow your account when you're protecting against worst case scenario, and that's losing a ton of money. Because I can promise you, if you run the math, you look at it, Warren Buffett has these cute little 2 rules, but when you put math behind those 2 rules, it will freak you out. You will really see losses are the devil. Major losses are the devil. You have to minimize that because I ran a scenario where I lost 20% in my account. I can get that back in a year. Same scenario, a guy lost 60%. He lost 3 times more than me. But guess how much he needs to get back to break even? 6 times more, a bigger return than me. If I lose 20%, let's give you numbers. If I lose 20%, I need a 25% return to get back to break even, right? I can recoup that in a year. He lost 60% of his account. He needs 150% return on his remaining balance to get back to break even. His return needs to be 6 times higher than mine. So think about that. How unfair is losses? Like you need like a 3x return just to get back to where you started. So that's why you really need to understand losses. Gains are beautiful. Me and Peter were talking about it before we started recording. Gains are like this. You're going along, compounding, and then like the last few years, your account just takes off like a rocket. And that's compound interest. It's the opposite. You want that working for you, and you want to guard against the losses. So that I'll just lose everybody on that, Peter.
No, it needs to be said. It needs to be hammered home. That's what you need to do.
Yeah. So losing money is normal. Just protect yourself from losing a crap ton of money. So that's the summary there.
Yep.
All right. Well, that's it, everybody. Hey, hope you all enjoyed this recap, and we will see you in next week's recap. I think I'll be on. Yeah, I'll be available to do it. If you have any questions, just ask us wherever this video is posted. Hey, you all take care. See you next week.